Hey guys, today we're going to be taking a look at income statements for the first time. And income statements are very important because it tells us how much profit we're making. Now that profit can be shared in lots of different ways. So we're going to be taking a look at the breakdown of profit in different levels. And we're going to be taking a look at that sheet together. We're going to do a whole group practice, so you'll watch me do one. And then we'll have another video where you watch me do one, but then you answer questions. So let's just go ahead and jump into it, and I'll show you what I'm talking about. So here we have Company A, and there's a lot going on. We have income statements, balance sheets, statements of stockholders' equity, statements of cash flows, statement of retained earnings. Now, we're not doing all of that today. And then we also have this given section. Now, this given section is stuff that's already been recorded. Throughout the year, we accounted for things, we kept track of it, and this is the values at the end of the year. And so we already know these things. But we've got to create a income statement today to show how much did we make. And this is important not only for the company to understand, did we make money or did we lose money? It's important for investors, people who want to buy your stock. It's important for just for banks, because if you're not making money, they're not going to want to loan any money to your business. So the income statement is a good place to start when you want to look at a company's earnings. How much money are they making? Are they going to grow? That kind of thing. So let's take a look. So this company A, had net sales of $605,279. So that's how much they sold. That's how much money they made off the sales. And that would be over here in given. That's where that came from. Okay, now of course you can't just make things without it costing something, typically. So this is operating costs, excluding depreciation and amortization. Okay, so this is what it would cost just to make that $605,000. So of course the $605,000 is not my profit. I've got to figure out how much money did I actually make off of my sales. So what I do is I press equals, and we're going to take sales minus the cost of those sales, and we get EBITDA or EBITDA. I've heard it said a lot of different ways, but pretty much this is earnings before interest, taxes, depreciation, and amortization. So there's quite a few things still left for us to do. Obviously, you see depreciation, amortization, interest, taxes. That's the ITDA. This is DAIT. So before all these things come off, this is how much we've earned, which is a lot, but we do have some things to take off. Okay, so let's keep going. Depreciation. So let's say we owned a large factory. Over time, that factory loses value, right? Just like a car. You buy a car, it's not going to be worth the same amount in 5 years. You won't be able to sell it for what you bought it for, unless it's like a classic or something, or maybe you souped it up. I don't know. But normally, something that you bought loses value. So what we call that depreciation. Our stuff is not worth as much. Okay, and so we have that here in the sheet. We also have amortization, and that's like money we spent to buy the building, and we're making payments on that. So that right there needs to come out of our earnings, because we had to pay for that asset so that we can make money. Okay, so these are all necessary things, but we need to remove them from our earnings. Okay, so let's find out what the total of these two are. Depreciation and amortization. So we're just going to press equal. There's a couple ways you can do this. You can use the sum function. So that sums it up, adds it together. So sum with the parentheses, and we just put these two in there. Or you can do old-fashioned, this plus this, same amount. Okay, so we had $47,000 in depreciation and amortization. We're going to take that out of our EBITDA. Okay, so this is going to be equal to our earnings minus the depreciation and amortization. Okay, so now we have EBIT or EBIT. Okay, and that looks a lot the same, but it's because now we've taken out the depreciation and amortization, and so the DA is gone, and we're left with EBIT. Okay. So this is now my earnings after we've lost depreciation and amortization. All right, let's go ahead and go to interest. So we've got this interest here. All right, so this is, again, we're making payments on things, and the interest that we're having to pay out for having these things, for the loans that we have to buy these assets, it also decreases how much we've earned. And so we need to calculate EBT, that's the interest coming out. So we're going to do equals the value of EBIT now minus the interest. So if I want to know what the profit is before taxes, this is my earnings before taxes, it's $91,000, which is great. It's still a lot of money, but you can see it's fallen quite a bit since the 153. Okay, so that's why it's important to look at all the different measurements. But we still aren't done. Now we got taxes. So right now corporate taxes are 21% across the board, and that makes that really easy for us. Otherwise, this would actually be a little bit more complicated to calculate. But you can actually thank Trump for that one. He made our math easy, even if it's maybe a terrible policy. I don't know. We can argue that later. So equal, we got $91,530, and we are going to multiply that by 0.21. That's 21%. 0.21, 21%. That's how much taxes we're going to owe off that. So we owe $19,000 in taxes to the federal government for our business. So now we have net income. So notice that the EB has gone away because this was earnings before, but there's nothing left before to do. So now we just are going to call this net income, which is our earnings. So net income before dividends though. So now there's another level of things that we haven't yet taken out. So let's figure that out. So we got equal my earnings before the taxes minus the taxes, and we have our earnings. But this is earnings or net income before preferred dividends. Okay, so we have some preferred dividends to account for. All right, so we have some net dividends here, and we need to take these promised dividends to preferred. Remember, preferred always gets theirs first. That's why it's preferred. So we're going to subtract the dividends out of the net income. So we got equals my $72,000 minus the preferred dividends we promised, and we're left with $70,000. Now this is called net income. So that's the profit we've made. But we're not going to keep it all because we have shareholders that expect to get some of the profit. And so those shareholders are going to get paid some of what we've earned. We've earned $70,000. They want some of the pie. So we've promised them this year. We've chosen, common dividends don't always happen. We've chosen to send some of that money back out. The rest we're going to keep. So we're going to pay out $8,078. All right, so we got equals $70,000 minus the $8,000. And now we have an addition to retained earnings. That's the profit that we made that we're gonna keep. And we might choose to next year reinvest that money, buy a new factory so we can make more products. We might need to replace some things, some machines to make our product. We might need to hire a new person to lead up some division. We might do research for a new product. This money is ours to use to help the company. So that is the income statement. And hopefully you got a lot out of that. If not, we will be doing another one tomorrow. And if you have questions, of course, make sure you email me, or if you're in class, just talk to me, and I can explain this with you further. All right, see you next time.